Curious about which dividend stocks are currently at their 52-week lows with a huge upside potential and why they might be the perfect addition to your portfolio? In this video, I'll show you the financials, performance, and future prospects of 5 such companies and opportunities that only come along every once in a while. I'll show you and John how much you can earn in dividends from a $10,000 investment in each of these stocks. In the end, I'll show you and John a stock that has the potential to reach a multi-million-dollar investment valuation and pay over $30,000 in dividends each month. Coming up next are stocks ranked from good to the highest portfolio in dividend return. Starting at number 5, we have Johnson & Johnson, or J&J as it's often called. Johnson & Johnson is a name that's practically synonymous with the healthcare industry. This multinational corporation has a diverse portfolio that spans pharmaceuticals, medical devices, and consumer health products. Now, if you're someone keeping an eye on the stock market, you'll find J&J's recent performance particularly interesting. Over the past 52 weeks, their stock hit a low of $143.13, which is a notable drop, down 16.65% from its 52-week high. While that might sound concerning at first glance, strategic investors like John recognize this dip as a golden buying opportunity. Let's break it down further. Analysts have mixed yet generally positive opinions on J&J. According to a quant rating, it's a hold, but both Seeking Alpha analysts and Wall Street analysts give it a thumbs up with a buy rating. They offer a current dividend yield of 3.38%, coupled with an impressive dividend growth rate of 6.02%. Over the past decade, J&J's average share price has appreciated by 3.68% annually. Based on these metrics, if John invests $10,000 in J&J today, projections suggest that this investment could grow to $10,706 after 1 year. In 10 years, it has the potential to reach $20,496. Over 20 years, it could be worth $45,989. And after 30 years, it could be valued at $115,529 with an annual dividend payout of $6,921. In total, that's $105,529 in added value, $42,464 from capital appreciation, and a whopping $63,065 from reinvested dividends. From a strategic standpoint, Johnson & Johnson is a powerhouse. Their diversified portfolio minimizes risk and ensures stability across various market conditions. They're also big on research and development, constantly pushing the envelope to stay ahead in the healthcare industry. Their strong global presence and efficient supply chain are the cherries on top. As the demand for healthcare products and services continues to rise, J&J's leadership and innovation are set to drive future growth and profitability. Up next, we have the iconic Nike with the ticker symbol NKE. Nike is more than just a name. It's a global leader in athletic footwear, apparel, and equipment. This powerhouse in the sports industry has built a brand that resonates with athletes and consumers worldwide. Right now, this stock presents an interesting investment opportunity thanks to its solid financial health and promising potential for future growth despite its stock being at a lower point over the past year. It recently hit a 52-week low of $88.66, a significant drop of 22.97% from its 52-week high. While such a decrease might seem alarming at first, seeing the brand name we all know and love, this drop actually offers a golden entry point for investors. Analysts have been slightly pessimistic, with quant rating and SA analysts rating Nike at hold, while Wall Street analysts rate it as buy. This reflects cautious optimism about Nike's ability to bounce back and continue its upward trajectory. When we look at the numbers, the company offers a current dividend yield of 1.56% and has a remarkable dividend growth rate of 12.18%. Over the past decade, Nike's average share price has appreciated by 9.5% annually. So what if John invested $10,000 in Nike today? Projections suggest that this investment could grow to around $11,106 in just 1 year. In 10 years, it could be worth $29,068. Holding on for 20 years, it has the potential to grow to $88,637. And in 30 years, the initial $10,000 investment has the potential to reach $287,579, paying $8,563 in dividends every year. The total value added from this investment would be $277,579, with $214,154 from capital appreciation and $63,425 from reinvested dividends. Now, if you think this is a good return, wait for the next stock. It might have the potential to cross the $500,000 valuation, and in the end, I'll show you a stock that pays close to $500,000 in yearly dividends alone. Back to Nike. Strategically, the business is primed for continued success. Their strong brand equity, extensive global distribution network, and relentless innovation and product development give them a significant competitive edge. Nike's hefty investments in marketing and athlete endorsements keep it at the forefront of consumer demand. Plus, the expansion of their direct-to-consumer business model increases profitability and strengthens customer relationships. As the global demand for athletic wear keeps growing, Nike's leadership in this sector is expected to drive future growth and profitability. Third on the list is Accenture plc, known by its ticker symbol ACN. If you're into global professional services, consulting, or outsourcing, this company's a big deal. Accenture is all about innovation and digital transformation, and they've really carved out a niche for themselves as leaders in the fast-changing tech landscape. Now, even though their stock has taken a dip this year, don't let that fool you. This could actually be a fantastic investment opportunity. So here's the up-to-date info. ACN has hit a 52-week low of $278, which is quite a bit lower than its 52-week high, marking a decrease of 27.15%. This drop might seem like a red flag, but it's actually a green light for investors looking to buy shares of a top-notch company at a bargain price. Analysts seem to agree. Despite the dip, they've got a pretty positive outlook on ACN. With a quant rating of hold, a Seeking Alpha analyst's rating of buy, and a Wall Street analyst's rating of buy, there's a strong vote of confidence in Accenture's ability to bounce back and grow. The company offers a current dividend yield of 1.83% and has a dividend growth rate of 11.11%. Despite the recent drop over the past decade, the average share price has appreciated by 13.26% annually. Based on these metrics, if John invests $10,000 in this stock today, in 1 year that investment could grow to about $11,509. Stick with it for 10 years, and it has the potential to quadruple and reach $40,184. In 20 years, it could be worth $156,972. And after 30 years, an impressive $599,340, paying $5,112 in annual dividends. All in all, the total value added from this investment would be $589,340, with $543,070 from capital appreciation and $46,269 from reinvested dividends. Strategically, Accenture is in a sweet spot for continued growth. Their extensive range of services, including digital, cloud, and security solutions, aligns perfectly with the current trends towards digital transformation and cybersecurity. The company's hefty investments in cutting-edge technologies and smart acquisitions keep them ahead of the curve, expanding their market reach. Plus, their strong client relationships and global presence ensure a steady stream of revenue and growth opportunities. As more and more businesses jump on the digital bandwagon, Accenture's leadership in this space is set to drive future growth and profitability. Now, before showing you today's top pick that has the potential to make John a multimillionaire, at number 2, we have AbbVie, or ABBV as it's known on the stock exchange. This global biopharmaceutical company is a major player in the healthcare industry, especially in immunology, oncology, and virology. If you've heard of the famous drug Humira, then you know AbbVie. Despite a recent dip in its stock price, AbbVie remains a compelling investment opportunity thanks to its solid financial health and promising growth prospects. The company's stock recently hit a 52-week low of $130.96, down 11.84% from its high. Analysts suggest this might be the best entry point, with a quant rating of hold, an SA analyst's rating of buy, and a Wall Street analyst's rating of buy. Here's where things get really interesting. AbbVie offers a current dividend yield of 3.85% and a remarkable dividend growth rate of 14.1%. Over the past decade, the company's average share price has appreciated by 11.53% annually. This is a company that clearly values its shareholders, delivering consistent dividends and substantial capital appreciation. So here's the breakdown of John's $10,000 in AbbVie today. Projections suggest that this investment could grow to about $11,538 in 1 year. In 10 years, it has the potential to reach $43,569. Hold on for 20 years and it could reach $211,339. And if you're in it for the long term, after 30 years, the initial investment has the potential to reach $1,175,260, paying $79,014 in annual dividends. That's a monthly dividend income of $6,585. In total, this investment could add $1,165,260 in value, with $722,028 coming from capital appreciation and $443,233 from reinvested dividends. AbbVie is set up for continued success. They have a diverse portfolio of high-margin products and a robust pipeline of new drugs, ensuring steady revenue and expansion potential. Strategic acquisitions like the purchase of Allergan have massively improved their market position and expanded their product offerings. The company's focus on research and development and its ability to bring new treatments to market gives them a competitive edge. And as global demand for advanced healthcare solutions continues to grow, like it has been, the company is expected to drive future growth and profitability. And now, our top pick for the 52-week low stocks is none other than NetEase, known on the stock market as NTES. This leading Chinese tech company specializes in online services like gaming, e-commerce, and internet content. If you're into the gaming scene, you've probably come across some of their popular titles that attract millions of users globally. The company's stock recently hit a 52-week low of $81.30, making a significant decrease of 25.12% from its 52-week high. But analysts are optimistic about the stock, giving it a quant rating of hold, an SA analyst's rating of buy, and a Wall Street analyst's rating of strong buy. The company is positioned for ongoing success. Their broad range of online services, particularly in gaming, is perfectly aligned with current trends towards digital entertainment and e-commerce. NetEase's investments in cutting-edge technologies and strategic partnerships give them a competitive edge and expand their market reach. With strong brand reputation and a large user base, the company ensures a steady stream of revenue and growth opportunities. The company has a current dividend yield of 2.22%, with an impressive dividend growth rate of 24.7%. Over the past decade, the company's average share price has appreciated by 20.29% annually. These metrics highlight NetEase's commitment to rewarding its shareholders through regular dividend payments and massive capital appreciation. Here's the breakdown of John's $10,000 in this stock. Based on projections, this investment could grow to around $12,251 in just 1 year. If he holds on to it for 10 years, it could be worth $79,279. In 20 years, John's looking at a $707,636 valuation. Give it 10 more years and it has the potential to reach an incredible $7,560,867. Plus, dividends would significantly improve these returns, with annual dividends reaching upwards of $458,640. That's a monthly dividend income of $38,220. Altogether, your investment would add $7,550,867 in total value, with $5,679,348 from capital appreciation and $1,871,519 from reinvested dividends. If you want to get paid over $1 million in dividends, click the video on the screen to see Warren Buffett's top winners.